Well, Asian markets, they are fairly cautious in this morning's trading session, despite the optimism from reports that the Chinese president is scheduled to meet with the high-level members of the US delegation in China. So even on the back of that news, we're seeing that those markets, well, they're more or less flattish, or they're trading in the negative terrain. The Nikkei is as flat as can be. Keep an eye out on the yen. That's moving towards 111 odd mark. So that's good news actually for that particular market. But other markets, the Kospi was down close to 0.2%. Now it's down close to around 0.4%. And let's pull up the other couple of markets to see how they've opened up. The Straits as well as the Taiwanese index, well, more or less flattish with a bit of a positive bias. So fair to say, Asian markets mixed, but the SGX Nifty, we've seen it in the last couple of days. Last hour of trade, we have seen selling. Today as well, it's indicating maybe the start only will be in the red. Maybe they'll do, a reverse of what it's been doing in the last couple of days. We've been starting off in the green and then slipping in the last hour. Bulls will be hoping maybe this time around the story is different.
But on the US markets, the positive cues are coming in and most of the stocks closed higher in overnight session, with the S&P 500 and Nasdaq rising for a fourth straight session and Dow Jones rising over 100 points after President Donald Trump said he may let a China trade deal deadline slide if the two sides were making enough progress. CNBC's Aditya Roy gets us a wrap of all the action on Wall Street.
Lingering uncertainty amid some of the positive signs that we saw today, like the trade negotiations that you mentioned. Stocks rising on Wednesday as investors grew hopeful that the Chinese and U.S. trade officials would reach an agreement before that March 1st deadline. The Dow climbed 117 points as Walgreens Boots Alliance and 3M outperformed. It was a second straight day of gains. The S&P rose 8. Energy stocks got a big boost from higher oil prices. The energy sector gained 1%, led by Newfield Exploration, Apache, and Devon Energy, as West Texas Intermediate futures climbed 1.5%, and the Nasdaq climbed 5 points. Shares of Hilton Worldwide climbed nearly 6% after the company reported better than expected earnings. And in other earnings news, Cisco shares rising after reporting a top and bottom line beat. Earnings were 73 cents a share, a penny beat over analyst expectations, and revenue was $12.45 billion versus analyst predictions of $12.41 billion. Cisco's largest business segment, which includes data center switches and routers, also beat expectations. So did applications revenue and security revenue. In other news, insurance giant AIG shares, though, went the other way, declining after missing earnings estimates, a loss of 63 cents versus analyst expectations of 42 cents in the green. Now, the company also added $2 billion to a stock buyback program. The insurance company cited natural disasters, including the California wildfires, with contributing to those losses.
Well, on that note, here is some opinion from experts on the road ahead for the US markets.
Very sharp V-bottom like we had in December. S&P down 20% very briefly and now up about 16% from there. You do generally tend to see some sort of retest, not a complete retest, but maybe a 50% retracement or something like that. So that's a fairly common technical development. So the question is, what would drive that? It could be disappointment over trade, earnings growth. Estimates are falling very quickly. We're down to about 5% for 2019, and at this rate, we're lucky to get anything positive, really.
Major impact to the sell-off kind of last year was the fact that earnings were decelerating in negative revisions, right? Now that you've had those negative revisions, some of that was incorporating even a 25% tariff as it relates to China. And if you have that move and you have incremental progression, that does not happen. What's going to happen is you're going to start to see earnings come in better.
Well, the European markets, they ended higher amid renewed optimism that the United States and China may be able to resolve their trade dispute. But on the data front, it's looking quite disappointing, actually. The British inflation fell to two-year lows in January to around 1.8%. Slipping below the Bank of England's target in that process. So that was one data point, inflation lower than estimated. Additionally, the Eurozone industrial production, that as well was weaker than expected in the month of December. But on those optimism of there's going to be a resolution between the United States and China, all the three indices ending in the green.
Well, moving on to the currency space, the dollar strengthened as January consumer prices came in unchanged for the third straight month. Meanwhile, improvement in risk appetite undermined demand for Japanese yen.
And in the world of commodities, then crude oil prices rise on hopes of the potential progress in the latest US-China trade tariff talks. That's likely to improve global economic outlook if it comes about. Brent crude prices trading closer towards $64 a barrel. NYMEX as well is holding up with a gain of closer around 0.5% odd.
As Saudi Arabia cuts oil production, hear out what RBC Capital Markets' Hemila Croft had to say about the current scenario and the outlook on oil prices going ahead.
I think the Saudis are very, very serious about trying to push oil prices higher. I mean, if you look at the budget for this year, they have a 7% increase in spending. So they have clear revenue needs. And so I think it's just reflected in terms of their oil policy. They're back in whatever it takes mode. They are bearing the burden of adjustment. I mean, to be fair, they were the ones who really oversupplied the market over the summer. So they are rolling that back now. They've had some help from Kuwait, UAE, but this is a Saudi-led policy. I think it's a real concern about what is happening in China, what is happening with global growth, and I think that it's a real headwind for oil right now. I mean, the supply picture is tightening, but if people believe that the trade talks will break down or you have slowing growth in China, that's an obvious headwind. The fears of a slowdown can drive prices much lower. So we are concerned about the sort of macro picture for oil. I mean, a lot of the sell-off that we saw in the last quarter of last year was really about macro concerns.
Well, on to our mega CNBC TV 18 exclusive then. Veteran banker and executive vice chairman and MD of Kotak Mahindra Bank says that the small and mid-cap sector has already seen a lot of pain. Speaking to Shireen Pan, he adds that the pain in the real estate sector is not yet over.
I think at this point of time, my personal view is the SME, the small and mid-cap sector has already seen a lot of the pain. And the pain from here may not be anywhere near the pain people have seen in 2018. Therefore, I do believe that small and mid-cap maybe have adjusted more compared to what we have seen in larger caps in general. And I think there has been a flight to safety. A lot more money has moved into larger cap and fewer number of stocks in terms of the marketplace. My concern at this point of time continues to be in the residential real estate space, which I think is still facing its pressures. And it's back to fundamental affordability in many major cities for people to be able to really buy an apartment and look at financing it over a long period of time. Therefore, this correction, however painful, over a period of time, actually makes it far more affordable for individuals and consumers to get sensible pricing on housing. Okay. But in the short run, I think there's been too much of land financing which has happened, and that pain is playing out.
It could get worse before it starts to see
some areas
a recovery?
The pain may not be fully done.
Which areas?
I think, as I said, real estate is one area which I would seriously worry about. Second is a lot of trading companies with very little core value add may have more pain to go in. And the third is, we still have to see how the telecom battle plays out between the three big players. So the question in people's mind is there room for 3 or 2 or only 1? So some of those issues will also get addressed between 2019 and 2020.
Okay, that's the word coming in from Uday Kotak. But now it's time for a quick break. Up next, all the cues and news you need to know for trade this morning.